One of the things that makes it very difficult for traders is dealing with inventory that becomes either too long or too short. When inventory is too long or too short, the market does not follow normal conventions. And the reason for this is when traders are caught too long or too short, emotions run very high. And we all know what we do when our emotions are out of check. We tend to make some bad decisions, and they're not necessarily rational, and they're not really very predictable. So we're going to start off, and we're looking at Sunday night, the 4th of August. Early overnight on Sunday, the market is very quiet in a very tight range. We then start to get more trade talk. And again, this sets off an emotional trade. Notice how the market in G period begins to trade sharply lower. G period, H period, and what you'll see as overnight trade continues, by the time we get to Monday morning, we will gap substantially lower. The bigger the gap, the greater the odds are that the market will continue in the direction of that gap. As we open on Monday, overnight inventory is meaningfully short. We've talked many times, if overnight inventory is short, the odds favor a rally, and that would be a rally to allow inventory to rebalance. If market inventory from overnight trade is short and the market doesn't care or doesn't rebalance, that is usually an indication of a market that is very weak. As we open on Monday the 5th, the market pays no attention to overnight inventory from Sunday. And as you see, the market trades off immediately in A period. Let's follow Monday all the way down. Notice how thin the profile is. There's multiple distributions until we get all the way down to the low. So you see that finally there's a little bit of balance, and then the market continues lower again. So the market is substantially lower on Monday. Volume was moderate at best, particularly for the range traveled. It is a safe assumption at this point. Even if the market doesn't go lower, it is a safe assumption at this point. Relative to the size of the gap from Sunday and the elongated trade on Monday, that as we come into Tuesday, the market is very short. Now, just because the market's short, that doesn't mean that the market is going to rally. It just means that the conditions are emotional and the market is very short. So let's take a look at overnight on Tuesday, or overnight on Monday, I'm sorry. Look at overnight on Monday. It trades quite low. Let's keep going down there. So you see the low, and now let's follow up after the market opens so low. Let's see what happens during the overnight trade. Overnight trade rallies substantially back into Monday. As we said, there was a concern that inventory was exceptionally short. That doesn't mean the market has to rally, but the odds certainly are in that direction. So we got a meaningful rally overnight on Monday. So the risk of being short when you went home Monday was very, very high. All right, let's take a look on the 6th. Let's see where the market opens on the 6th and be able to follow that trade through. So we know that overnight inventory is long. And we know if overnight inventory is long, even though it was correction to a lot of inventory from Monday, we still look to see inventory. So overnight inventory is long. Tuesday opens near the high of the overnight trade. So it's an inside day relative to Monday. The market rallies, takes out the overnight high, and trades well into the early part of Monday. So the market is, you're seeing a lot of single prints. We are actually seeing the market trade above the high of the value area from Monday. So we've seen a market on Monday that got emotionally very, very short. We saw short covering on Monday night, and there's probably a lot of emotion with that. And now we have an opening on Tuesday that is within Monday's range. So the first, early on, the market traded higher. It's now traded back down to below half back. And the market is still beginning, we're trading it, we're running at 5 times normal speed. So you see, it's faster than it actually would be. But we're inside Monday's range. When you're inside the previous day's range, the odds are that you will get rotational trade. At least early on, we are getting rotational trade. All right, what I really want to show you occurs later on in the day. So this is very normal. The market got very short, extreme emotions on Monday. When you see those extreme emotions, so many times people are price-based. If you're following price, the market looks terrible. If you look at the structure and how elongated the structure was, it indicates to you that there is an awful lot of risk in the market. And the structure from Monday also suggests that so much of the trading on the downside was emotional. Why would I say that? If you have serious investment money in a market, they usually do not murder a market. They'll sell, they'll let the market settle, then they'll sell some more, but they don't take the market straight down and kill it. That is what happens when short-term or retail traders, get emotional. They kill the market. All right, so now we've got an inside day on the 6th. Rotational is what is in play. The odds are that opening within the inside day, that we will get continual short covering, because the overnight trade, while it was long, there's a lot of traders that don't trade overnight. So it's likely that there's still a lot of shorts from Monday. And it's likely that we get short covering as Tuesday goes on. So right now we have rotation, which is what we would expect on an inside opening. Okay, let's speed it up to about 8 times. So we said we're seeing a lot of rotation early on. To be expected, inside day, the market was emotional on Monday. It was emotional overnight. And you can see there's a tremendous amount of uncertainty. When the market opens on an inside day, my recommendation is do not trade early. It's likely that the market is going to have a lot of chop, which means a lot of uncertainty. Let somebody else pay the price for investigating that uncertainty. Stay away from the chop. There are always 1 or 2 good trades throughout a session if you have patience and let the market tell you what it wants to do. Right now, we've been back and forth multiple times, and it would be very hard for me to read this market. So I'm very content to sit back, let the market trade. Although I suspect that the order of the day is going to be short covering, because market understanding tells me that the market got very, very short on Monday. Even though we had short covering and the market up overnight, the volume usually is not nearly as high as it is during the day. So you get some short covering and then you get some new longs, but it's unlikely that the short covering that took place on Monday is totally corrected overnight. So B period opens inside A period, which is inside Monday's range. So the market continues to have chop and it continues to be contained within Monday's range. So early on Tuesday, very hard for me to have a read of what's really going on in the market. And again, as I've said so many times, there is no shame in sitting a market out. Too much money and psychological capital is expended during these inside days when people get caught in the chop. There will be many people out there, they're both long and short and lost a lot of money during this early market. The excitement level, their excitement level, their emotional level is too high. That is something we clearly have to control. So remember, when I'm looking at this market, I'm coming in and I'm saying, yes, price went considerably lower on Monday. However, I think the market is very short. And I say that because it looked to me like the selling on Monday was mostly emotional. And I say that because of how thin and how strung out the market was. As I repeat, longer term money or investment capital is not out to destroy a market. Okay, so the market trades down and continues to push lower. We're trading now around the half back level from Monday. Half back is always a level that short-term traders pay attention to. They're constantly look at half back, they look at overnight high and low, they look at the very prominent point of control from overnight. They're very visible, very easy references to see. Okay, the market continues to trade off. We're right around the half back level from Monday. Remember, it is inside day. We expect chop, and that's what we're getting. Absolutely no certainty in here this morning. The easy thing is for traders to get caught short because they saw how far the market went down on Monday. I'm very cautious when a market goes down like that the market is too short, and I don't want to get caught in a short covering rally. Sometimes I'm right, sometimes I'm wrong. Okay, so the market looked down below half back from Monday, got rejected, and the market now is trading in the upper end of Monday's range. But again, from this chop, we have no clear decision. Okay, let's speed up to about 10 times. So remember, we're trading at a very fast speed here, still within the chop. Okay, we changed time periods. C period opens within B period. Half back from the 6th. Half back is always a reference. Again, because it's very easy to see. Even though we're playing at a very high rate of speed, you still see these references. And you see, this helps you understand the behavior of the people that we are trading against. When they use these references, it gives us a pretty good clue that we're not looking at longer term money. They don't know where these references are. Okay, so we've come up well past half back to the overnight high. So you get some idea of the recommendation that there's chop in the morning, to be careful of that chop. Pretty good advice in here. But it's very difficult many times for traders to leave their hands off of a market like this. Many times the emotional level, people come in the morning, oh, they're looking for the perfect trade. If you find a trade in a situation like this, the odds are it's not a good trade. And let the market settle down. We're now, a little over an hour into the market. We're right at half back again, and we're continuing to get a lot of volatility in the market. Okay, let's speed up to about 15 times. So register the uncertainty in this market. And people say, well, there were some good trades in there. There were some good trades in there if you got it right. But, that's awful easy to say if you got it right. When you're in there and you get the emotions triggered off by the volatility of trading up and down, it's very hard. It's very hard to get it right. You get it right one day, you get it wrong the next day. The clue is to have patience, be able to sit back and see if the market gives you anything that's clearer before the day is over. Notice the D period high is just a tick or two below half back for the session. We said those are always very meaningful references because those are the references that short-term traders use. So we're trading back down near the low, still within Monday's range, still very choppy. So we ask ourselves, what are clear references that traders can see? They can see the early morning low, they can see half back. And remember, the odds are that the market is still short from Monday. What happens to us many times, we see a market opens like this and we get the chop and we get lost. We get lost in the market thinking the market is very weak. And in fact, it's a choppy market. Okay, so we're trading lower. So one more time, we're back below half back from Monday. Let's speed it up to about 20 times. So we're going at a very high rate of speed, but notice we continually see chop in a market like this. It is not uncommon following a big emotional break such as we had on Monday for the market to be very choppy on the following day, which allows at least short-term trading money to come into balance. Remember, traders continue to push on the lows. This is what worked yesterday. All day yesterday, the money was made by pushing on the lows. So it's easy to get trapped in here. Remember, it's an inside day. At this point in time, we have a poor DE low. It's a poor low because there is no excess, no single prints. That is always a piece of information to carry forward. One of the tricky things about poor lows is that sometimes they occur when a market is too short. Think about the behavior of traders when they get caught too short. The tendency is to buy at any reference that allows them to get out of that market. Their nervousness is there, and it's not uncommon to have a poor low when a market is too short. So you see we have a poor low, but one more time, the market has rallied right, look at that, right back up to and through half back. The chop continues, tremendous chop continues in the market. Odds are there's been a lot of money lost from short-term traders on a day like this. It's been very difficult. I know we're playing at a very high speed. It's been very difficult for me to see and identify trades on a day like this. And I just set them out. Okay, so the market looked above half back. They sold the market off again.
Jim, do you want me to start slowing it down?
Yeah. Okay. So what we're seeing in here, we're seeing short covering. There's been buying of the market on every break. Now let's stop here for just a second. The market was very short from Monday. They've sold the market off multiple times on Tuesday. If you notice, on almost every rally, the market has been sold. Yes, every low it's been bought. We have a poor low, but the predominant selling has taken place on every rally. When that occurs, what do you think is happening to short-term inventory? Is that short-term inventory being corrected or lightening up relative to Monday? Or do you think that short-term inventory may be getting even shorter? Remember, looks to me like traders are selling every rally. Okay, let's go ahead and play this day.
What speed do you want it at?
Let's play about 5 times. So, we're about the center of the day and we're slowing this down. The market is again back and forth around the half back level. Most traders, again, have been selling every rally on a day like this. And that's very logical because, the trend is down. We didn't show it, but the monthly lows have been taken out. So the market's no longer one time framing higher on a monthly basis, no longer one time framing higher on a weekly basis. So it's very rational to be selling every break and to think, okay, we've got a trend reversal in here. But you have to always keep in mind that while that is very rational, the market was rallying. The rally didn't look that strong. There's been selling on every rally. Notice the market has been spending, a lot of time, A period, B period, C, D, E, F. Each of these periods, even though it was maybe not been exactly at half back at the time, but there's been a lot of activity at the halfway point. Almost every period has touched it or been very close to it. So again, it's a rotational day. It's an inside day. And with an inside day, the expectation is for rotation. And rotation is what we're getting so far. Now you say, well, we've got a poor low. With a poor low, aren't the odds good that we come back down and take that low out? That is a correct line of thought. Remember, the poor low is one single data point. It's not a series of poor lows. which would give us greater odds to take it out. It's a single poor low. It's one data point. Currently, we are getting, or continue to get chop relative to the inside day. Traders are selling every rally and trying to take the market lower. Very consistent. The question is, do they get themselves caught too short? Do we as traders get lost in that emotion and also do the same thing? It looks very logical. I remember this day distinctly, and it certainly felt like you wanted to short every rally. And I did some of that early, but I got very cautious because it was still an inside day. It was rotational, and I knew the market was very short. Now people ask, well, where would I get long? Where would I get short? Where would I put my stop? And I really don't know. And that's very frustrating to traders because they've been taught so much about, order placement and where to put your stop, where to put your entries, where to put your exit. And I really don't have those answers. Everybody would like those answers. And that's why there's been a lot of teaching about this, because it attracts traders, and it sounds like, oh, here's the answer. But I'll tell you that I don't know. And when I look at today, I'm better off to get a bigger picture of what is going on. And my bigger picture says it's an inside day. The market is very choppy. There's been a lot of trade taking place around half back. But we talk about market understanding and self-understanding. So the self-understanding is that we're selling every rally, which appears to be very rational because the market has turned lower. The other side is market understanding. And with market understanding, you look and say, wait a minute, this market got very short on Monday. Yes, some short covering overnight, but very short. And traders have gotten it even shorter today because they've been selling every rally. But there's been no real downside follow through on these rallies. Notice how much time we spent at the half back level. All right, let's speed it. What are we at? 5 times?
Yes.
Let's speed it up to about 8. So we're playing at a pretty fast speed. It'll seem slow because we're spending a lot of time here, but it's an extremely important day because these are the kind of days that can hurt you as a trader. We are developing a point of control. You see where it is 6 wide up there. The market continues to push lower. With the market pushing lower, notice we haven't gotten the low out. The low was made about an hour and a half ago, and the market has tried multiple times to go down and get that low. The more the market goes down and tries to take out that low, the more difficult it is, and the greater the odds that inventory is getting even shorter because they're constantly selling the market, targeting the low. And yes, it's a poor low, no excess. So the odds seem pretty reasonable that they can get that low. We're now, going into 2 hours of pushing on that low, and it's not been taken out. Remember, we're playing at 8 times the speed. But the market understanding that I see in here and that I saw on this particular day was that the market was pretty short. It was very short emotionally from Monday. There's been a tremendous amount of selling on Tuesday. Every time the market has rallied, the sellers have been there. And if you look up near the A period high, you'll see that we've not seriously challenged that. Can we look at the AB period high on the profile? Okay, so we have a selling tail up there. There's been no serious challenge to the AB high. One more time, the market is back to the halfway level for the day. Exactly at half back. Again, a very mechanical reference. So value is inside. Okay, so the market now has, the inventory was short from Monday. It appeared to me it was getting shorter on Tuesday, that the traders were selling every rally. Notice that the H period high is just a single tick below the opening. Could you put a red line on the opening? So the market went up to a very mechanical level and sold off. That is a very questionable H period high. I think that the odds are very high that we come back through that level. Again, it's easy to forget about how to read these references. So the references now are going to be the opening followed by the overnight high. Overnight inventory was long, and we probably got some liquidation of that inventory. So we're playing at 8 times earnings. We're getting later in the session, and the market has tried to sell off all day. And traders have probably gotten short and been very comfortable. But notice that value is inside Monday's value, and we have not been able to get substantially below half back today. The M period or H period high is weak because it's exactly at the opening. All right, so now let's speed the market up. What are we playing at? 12 times?
We're currently at 8.
Okay, let's go to 15. We're going to play very fast. We've talked a lot about this market and spent a lot of time on it deliberately because it is one of those days that it is very easy to get trapped. So you see the market rallying pretty sharply. We've now gone through the opening, which we said was questionable, and it has taken that out. We talked about inventory still being short from Monday, and we talked about inventory likely getting shorter all day Tuesday as traders were selling every rally. So we're playing a high rate of speed, but you see the market is, it's testing the highs again. Okay, let's speed it up to about 20 times. So what we've seen today is a really good video on market understanding. And there's probably 2 things to consider. Self-understanding. The self probably wanted to sell every rally. We saw price down yesterday, a huge gap. My guess is that emotionally we wanted to sell every rally. Market understanding said the market was probably very short from Monday and probably got shorter Tuesday because traders were selling every rally. And we noticed that, yes, we have a poor low. We'll carry that forward for another day, but we never could get substantially below half back. So now we're getting later in the session and the market is challenging the early morning high. Okay, let's go. What speed are we at?
20.
Let's go to 30. I wanted you to see the day and see how easy it is to confuse self-understanding with market understanding. Remember, opened inside, makes it choppy. It gave us chop, but a better understanding was that this continual selling without getting the low was getting the market even shorter. So we see this rally, and this was, this was something I think was in the making all day long. But it's really very hard to sort out because you saw the market lower, very rational. You saw a big short to the downside. You saw a big downward gap. A lot of changes taking place in the market. Okay, I don't think we need to play the rest of the day out unless we'll play it at full speed and we'll see what the rest of the day looks like. So we're wide open, but we were able to see what I thought was building. Now you combine this and say, well, Jim, there was a poor low. It is not uncommon to have a poor low when the market is too short. It's not uncommon to have a poor high when the market is too long. So the poor low was a single data point. But if you look at the market understanding what was going on, very consistent that the market got itself very, very short. All right, so as we're coming into the latter part of the session, we've taken out the A period high. We've gotten close up to Monday's high, but nothing's happened. So what I've seen in here is short covering late in the session. But again, I haven't seen that combination of short covering and new money buying. That is another question you're continually asking yourself. If you had a combination of short covering and new money buying, the odds are that we'd have taken the high and we'd have gotten into the gap. When I see this, it looks more like short covering than it does a combination of short covering and new money buying. Okay, so we're playing at very high speeds in here. And we've got how much time left on the session?
Less than 2 minutes for L period.
Okay, and then we got L, M, and N. So, there's M period. Then we get the runoff. So we got some short covering. Still remains to see a lot of volatility in the market. So it was an inside day. The odds were that we would get chop and rotation. Chop and rotation is what we have seen. It was also appeared that the market was short coming in and that the market continued to get shorter and shorter on Tuesday as traders sold every rally. Now, late in the session, those traders that were selling every rally, they're caught and being forced to cover their shorts. All right, what I'd like to do, I'd like to stop here. This is the runoff period. And I want to switch over to take a look at the current day. In the current day, the 9th of August, it is another very educational session. Our last discussion centered upon an inside day. Inside day, we said usually have a lot of chop and a lot of rotation. In that inside day, we talked about the potential for your self-understanding to get at cross purposes with your market understanding. We are looking at the 9th of August, another inside day, and I think another day that has the same potential. And why do I say that? Prior to the opening, one more time, there was talk about the trade war and talk about pressures that could traditionally send the market lower, or at least in the most recent type of market atmosphere. So that emotion can get you easily at cross purposes with what's really going on. So the market opens overnight inventory was short. We know that the odds are that there will be a counter auction relative to overnight inventory. One of the most recent days we look at, we didn't see that counter auction, and the market traded with high confidence straight down from the opening. So now we have another situation where there's a motion going on and relative to the trade war, but now the market opens, and it's the green dot. The market opens, and we get an immediate rally. That rally is consistent with overnight inventory being short. Notice the high. The high for A period is just a single tick below the overnight high. So the first thing I record is, yes, it's an inside day, but it's also an inside day that doesn't have maximum confidence. If this market had really strong confidence to the downside, the market would have opened and traded lower from the opening. Instead, this market opened, traded higher to within a tick of the overnight high, and then began to sell off. So what you've got to remember is this is not a sign of the highest confidence. So if the market starts to sell off later, you've got to be aware of this lower level of confidence. So let's look. So we start to sell off from A period. We get downward range extension in B period. Notice that B period goes all the way down and takes out the overnight low. Once the overnight low is taken out, the market trades back into the overnight range. D period extends to the downside, but once again comes back into the overnight range, comes back to half back for the day, and it's just a couple of ticks below D period. Look at the range for C and D period. If in fact the market had substantial confidence, you're not going to come back into that range more than likely. You're not going to come back that close to the C period high. But yet traders, hearing the talk about trade war, continue to trade and push this market higher or lower. So they push it lower in D period. They push it lower again in E period. Notice, let's mark the 2,900 level. If you can put your cursor or red line through 2,900, we know that for traders, that's just a very, emotional, easy to see level. The market trades several times, attempts to take out that level, rallies, attempts to take it out, rallies again, comes back, but notice it does not take out the low from the previous session. When that fails, remember, we've been recording from the opening period that overall confidence was low. Yet, if you're watching price today, price continued to trade lower. It traded lower in B, C, D, E, and F period. So for all those periods, the market traded lower. Think how easy it would be to get emotionally caught and want to be on the short side of the market. When we look a little deeper, we find that the confidence wasn't that high. The market traded below 2,900, no real exceptions, kept getting rejected from that area, and did not take out the low from the 8th. The odds are at this point that the market is going to rally. Now, you may say, well, you're looking at that in hindsight, but we're really not, because it's consistent with things we've talked about before. Inside day, choppy, rotational, and then we've added something else here, that the confidence, while price may have appeared to make it look like the confidence was high on the short side, confidence wasn't high. If you look at the A period high, just a single tick from the overnight high, that is not a sign of confidence. The fact that the market went higher before it went lower, That is not a sign of confidence. So the market overall was trading lower. Inventory was likely getting very, very short, and confidence was low. So what has happened, and the market hasn't closed yet, but what has happened, the market has rallied all the way back to just short of the opening price. Again, we're not going to go any further, but it was an inside day. If you could stop and read the confidence from the opening, it was not high. And I tell you this because I had some short positions on, and it was very difficult for me to take those short positions off because I kept thinking, boy, this market, they're selling this market off. The market's been weak. There's more emotional. I felt the same thing that most traders feel. I forced myself to take off the short positions. And luckily I did because you see what has taken place. Okay, again, another inside day. If you look at overall confidence, it was not that high, and we got exactly what's advertised on an inside day. One other example of being able to understand self-understanding and market understanding. They can sometimes be at odds. When they are at odds, that is when we have trouble and losses in the market. Once again, thank you very much.